Hello my dear friends and crypto traders, my name is Jack Klondike. I present the video researched by our Klondike team on the top 5 essential chart patterns. From the powerful Rising Wedges to the classic Bullish Flag, I'll show you how to identify these patterns and explain their impact on your trading. I'll also show you practical training that will improve your skills in technical analysis. So get ready to level up and watch the video till the very end. Let's talk about ascending or descending triangle. Well, this is a trend continuation pattern and it's simple to identify and trade. I'll show you how to do it visually. On the chart, first you must determine two levels: horizontal resistance or support and descending or ascending trend line. If it's a symmetrical triangle, two trend lines will converge to a single point. A triangle pattern can only form if there are at least two peaks and two bottoms. During a triangle's formation, the price trading range narrows and the trading volume should decrease. At the time of the breakthrough, there should be a sharp increase in volumes. Now let's discuss how to use triangles in trading after you find one on the chart. Enter a trade only after the breakout of the horizontal level, if it is an ascending or descending triangle. If you trade a symmetrical triangle, enter during a breakout of any level, ascending or descending. Just don't enter before the breakout happens. Remember to monitor trading volumes, which increase significantly during the break, and maintain that dynamic as the trend continues. Head and shoulders and inverse head and shoulders. Many traders are fond of the head and shoulders pattern, but most draw and trade it incorrectly, including its inverse version. So let's examine the primary rules for forming this pattern. For the head and shoulders pattern to form, it is necessary to have a trend in place. For instance, the classic head and shoulders pattern forms during an upward trend, while the inverse head and shoulders pattern forms during a downward trend. The left shoulder and head peak with a full rollback from the head's top signal decreasing demand and weakness of bulls. When you see a formation of the right shoulder, it means that the buyers cannot sustain growth and the asset is in the state of limbo. A horizontal support or resistance level marks the neckline. The neckline may have an upward or downward direction. However, you meet such cases less often than the classic horizontal one. The final confirmation of the pattern is the breakout of the horizontal level. This breakout means that the current trend is weak and needs some correction. Now let's discuss how to use head and shoulders in trading after you find the proper one on a chart. There are two possible ways: standard and aggressive. The standard way is simple. You enter a position after a neckline is broken. In this case, the candle that breaks the neckline must show increased volumes. The stop loss can be placed either above the neckline or just about the right shoulder. The aggressive and riskier at the same time method means entering the market once the peak of the right shoulder has formed. At this point, the asset is in a state of uncertainty and it's not yet clear if the trend will reverse. The stop loss should be tight, better to place it lower than the entry point. The bullish or bearish flag is a commonly found pattern on charts. This is because it requires a relatively short period of time to form. Scalping traders often draw flags even on 15 minutes time frame, but the cost of this speed is reduced accuracy. Let's take a closer look. First of all, this pattern is applicable only to the market with a strict trend, either upward or downward. Don't trade such patterns on a flat market, even if it looks pretty natural. Secondly, the price moves within two trend lines. A flag has the shape of two parallel lines which are directed downwards on an uptrend and upwards on a downtrend. And the last criterion is trading volume. Analogically to other patterns, you have probably already guessed that during the formation of patterns, trading volumes gradually decrease. This fact tells that traders do not hurry to get rid of their profitable positions and are waiting for the continuation of the initial trend. At the time of the breakout, trading activity immediately increases and keeps the positive dynamic as the trend develops. Since this pattern will be one of the most common shapes you find on a chart, let's discuss how to trade it properly. So for example, you see a strict uptrend, the price significantly grew and paused. You took some profits. After a short amount of time, you see the formation of a bullish flag. What do you have to do? There are two ways, as usual. The standard way is entering a position straight after the breakout. Stop loss should be placed slightly below or above the broken level. If you don't like taking risks, then you can enter a position during a retest of the broken level. However, you should remember that retests happen with flags very rarely, and you will probably miss 50% of current opportunities. And as a bonus, I have a little advice on how to set up targets when you trade flags. The flags have a so-called flagpole, which is equal to the size of the previous rise or fall of the price. This value needs to be placed upwards or downwards from the breakout point, and we will get a target level to which the price can rise or fall. Double top and double bottom are common reversal patterns in charts. There are also triple top and triple bottom. The formation criteria for these patterns are so similar to the double ones that we will focus solely on the double top and bottom. Now let's examine this pattern formation in charts. We will consider the double bottom as an example. The double top is exactly the same, but in reverse. The very first condition you need to look for is a strict downtrend. The stronger and longer it is, the greater chances that the new upward movement that you are going to trade will be just as powerful and profitable. The double bottom is similar to the letter W, which has low levels at approximately the same level. Also, you will often see that the second bottom is located slightly higher than the first one. This factor indicates the weakness of sellers who have been dumping the price for a long time and suddenly could not overcome the buyers. The most important condition is rollbacks or recovery from minimums. They should be at least 80% of the previous downward movement. You can use Fibonacci levels to measure, although everything can be seen with the naked eye. Remember, a trend does not cause doubts if its rollbacks make up about 50% of the previous price movement. It's effortless to trade double bottoms and double tops incorrectly. To avoid such cases that cause losses, let's find out how you should trade these patterns. Typically, traders use two methods. They either trade breakthrough or during a rollback. The standard way to open a position is to enter the market immediately when the support level is broken. Stop loss is best placed just below the support level. No need to take the stop too far from the entry point. Enter the market only when it returns to the level of resistance and confirms it as a support. This technique is called first rollback trading. And here is a small tip. Bullish markets give a retest of the broken level more often than the bearish one. Therefore, if you trade a double, triple bottom, you can stick to the second trading option. Here are falling and rising wedges, beloved by many and not without reason. In fact, the wedge pattern is very similar to a symmetrical triangle. Why? Because of the structure. The price moves within two trend lines to a single point. But these two patterns have significant differences, which I will explain to you within a couple of minutes. There are 5 criteria for the proper falling or rising wedge. The wedge pattern should be preceded by a trend, either up or down. Trading in a flat market can be difficult. Trend lines. The price should be consolidating between two trend lines, upward for a rising wedge and downward for a falling one. The lines should not be parallel. One line should have a steeper slope and the lines should converge towards a single point. Peaks and bottoms. There should be at least 2 peaks and 2 bottoms to form a wedge pattern. Timing. Wedge patterns take longer to form compared to flags. So don't try to find one on a 15-minute or even 1-hour chart. Declining volumes. As the wedge pattern develops, the trading range and volatility should narrow, leading to lower volumes. As the pattern breaks, the volumes should increase significantly, supporting the continuation of the trend. If you find a wedge that responds to all 5 criteria, then you're a fortunate person who is about to earn some great money. The one thing you need to do is enter a position correctly. Let me explain how to do it. You have already learned that there are always two possible options for entering a position, either during a breakout or after retest. My personal approach is entering on a breakout. Fakeouts are a scarce phenomenon for wedges. Usually they break out with a strong volume without any offered retest. Especially if we talk about altcoins. Bitcoin and Ethereum give retest more often. Well, that's it, guys, but we are not finished yet. In conclusion, I want to recommend you a method that will help you in practicing with finding and trading patterns. First, you need to log into your TradingView account and open BTC or Ethereum chart. For instance, tap on a replay button at the top of the TradingView window and roll it back for 10 to 14 days. Or as far as you want, and try to find patterns and draw them. Next, click on the play button at the bottom of the window and see how the price reacts to your patterns and trend lines. This will give you a priceless experience and teach you how to draw correct lines and find support and resistance. All in all, patterns play an essential role in successful crypto trading. They are like messages from the market, which you can decode with some skill. Patterns are giving traders valuable clues about what's to come. Understanding and recognizing these gives traders the power to make informed and conscious decisions. Not only that, but they also help traders manage risks by providing the perfect timing for entering and exiting trades. Thank you for watching. I'm sure this video has helped you understand the top 5 basic patterns for successful crypto trading. Remember, combining this knowledge with fundamental analysis, risk management, and a clear trading plan is crucial. Remember to practice in a demo trading account before risking real money. To stay up to date with trading moves and cryptocurrencies, you should subscribe to this channel, our Klondike Telegram channel, and our Twitter account. Links under the video in the comments. Let me know in the comments below which video you would desire to see from us next. If you have any questions or comments, leave them below. And remember to turn on notifications for more educational videos on crypto trading. Safe trading to you!